Okay, hello everyone, and welcome back. My name is Greg Furman, and this is the Vantage Point AI Market Outlook for the week of July the 22nd, 2024. Now, to get started this week, we'll begin with the US dollar index. Again, when we look at the dollar, it's important to remember that we are in the US fiscal fourth quarter, where the dollar is usually stronger in the month mid-August through to the end of September, and then it turns. So once again, we're holding below our very important quarterly opening price at 105.70. This is a critical level of resistance that the dollar must overtake if it has any chance of moving higher. Now, again, rate cuts now appear imminent, likely 2 to 3 rate cuts. It's almost guaranteed now for September. It's November and December are the ones that will affect the dollar. But either way, guys, the dollar usually sells off at the end of that fiscal fourth quarter, which is again October the 1st. The indicators here in Vantage Point are rising, suggesting this is a corrective move back to our T-cross long at 104.71. We have to overtake that to get to our quarterly opening, which comes in at 105.70, but that's likely where the dollar will fail either way. Now, on this dollar strength, we can see that gold, once again, in the Vantage Point Live training room, I've discussed this, and that we're exiting gold longs anywhere above 24.60. We're out of this, so we've had a full retracement here back to our T-cross long, 23.92. In most calendar years, the seasonal pattern in gold starts after October, and gold is strong right into January of the following year. So I do expect further downside on gold, but 23.26, our current quarterly opening price, very important. Now, the reason I'm emphasizing the quarterly opening because we have a first, second, and third and fourth quarter very similar to weather patterns, guys, where we have spring, summer, winter, and fall, and there's patterns that fall in each one of those: rain, snow, heat, all these things. But in the financial markets, it's very, very similar. So again, when we look at this, it doesn't surprise me that a bull trap was set up here on gold, up near this high at 24.49. Now we could rebound off of the T-cross long. That is still possible, but the Vantage Point indicators are pointing we are going to break the T-cross long and likely will head back to 23.26. But to emphasize gold longs, they are absolutely in play after mid-September here, guys. Now, when we look at the equity markets here using the S&P 500, everything basically responding to that dollar. Now, with that dollar strength, we have lower gold prices, we have lower oil prices, lower equities. So we have crossed over our T-cross long, but the line in the sand for next week here, guys, because again, this is a weekly outlook, 1 week only, not a monthly or a quarterly outlook. It's every week. So right now, 54.71, that is a critical level of support that most traders never see or use. If we break down below that quarterly opening, then we're bearish, and that would be reasonable, respecting the fact, again, we are in the US fiscal fourth quarter where there is real dollar demand in the month of September. So I do anticipate further downside on the equity markets, but we want to watch this level very, very closely around this quarter because we would have to break down. Now, we do have a short-term crossover, a medium-term crossover. That is the predicted difference crossing the zero line, and momentum on the predicted RSI breaking the 40 level is showing that there could be momentum building to the downside here. So again, we'll continue to watch this. But the indicator of that I will take note of is the neural index strength indicator, where we can internally see inside that neural index, and it's starting to reverse back up. So keep an eye on that level for next week, and be careful of a potential bear trap below that 54.71 area. When we do a comparative to the DAX 30, the European equities, we can see that they're identical, almost the exact same trade, the sell-off happening at the same time. This is evidence that the markets are becoming globally connected. So with the DAX moving lower, we've got a break of our quarterly opening price. That's coming in at 18,236. This would suggest to me that it is imminent the S&P 500 is going to break below its quarterly opening. The question is, can both stay below that? You can see the predicted differences are the same, but in this scenario, with this dark colored blue line crossing the zero line, we actually have a short, medium, and a long-term crossover. So is it possible the European equities are the direct correlation or the warning that the S&P, the Nasdaq, and some of the major US indices are going to move lower also? That is entirely possible. We do have momentum building here. So again, the next verified support low is going to come in at 17,915, but we must hold below this 18,236 to confirm that shorts are in play, but that is a reasonable play given the proximity to October the 1st that the equities are likely going to struggle here. Now, when we do a comparative analysis to the VIX, we can see that the VIX has broke its yearly opening price. We're firmly above our T-cross long. This is the strongest warning that the equity markets could be under pressure next week and for the remainder of July and potentially August. So again, the VIX yearly opening price, the VIX is officially turned positive on the year, 1501. As long as we're holding above 1501, then there is going to be a problem with the major indices. The one thing I will note here, the predicted RSI, 91.9. So definitely one could say a little bit overbought, but an overbought, oversold signal doesn't carry as much weight as what it used to in the current markets with the algorithmic programs, quantitative analysis, a number of different things where these programs will buy high and they will sell low. So, but again, the VIX is a leading indicator as to how the health of the equity markets, and this is suggesting the equities are in a little bit of trouble here. Now, when we look at Bitcoin, once again, Bitcoin is completely ignoring the other markets and extending higher. Now, we do have some verified resistance high. That's coming in at about 67,147. That's our immediate resistance for next week. Our T-cross long, that's coming in at 61,713. Our quarterly opening, very important, 61,933. That's our support level for next week. That's actually our support level for the remainder of the quarter, guys. And this is why it's important to use indiscriminate indicators that are price-based also with the intermarket analysis tools, because we always want to know where we are. Because the media will constantly spin this, that like they did the other week with Bitcoin. Bitcoin's going lower. Bitcoin's going to sell off because of what's happening with the Euro Bitcoin exchanges. None of that was relevant, guys. It was a trick to get you to short or exit your longs, and then Bitcoin goes higher. So by year end, the main seasonal pattern with Bitcoin is between mid to late September and mid-November, October being a very hot month for Bitcoin. So it looks like they're moving in on this already to get long. The indicators, my only little bit of a concern here is that MA diff cross here picked up on something. Now that was this week, not last week. So again, a little bit of concerning there. But as long as what we're really looking for is that T-cross long to cross over our quarterly opening price at 61,933, and that is a very bullish play. But it is very interesting that you can see that money is going into Bitcoin and not going into gold. You still have China and India buying gold as they've always been, but the reality is somebody much bigger is buying Bitcoin, and the likelihood that we move towards that 100,000 mark by the year end is a viable target here, guys. That's the best I can say. Now, light sweet crude oil, when we look at light sweet crude oil, once again, in my respectful opinion only, the direct inverse correlation is to nat gas. So if oil is moving lower, there's a strong seasonal pattern that begins right around now on natural gas, and this is actually confirming that. We've lost our T-cross long. We've lost our quarterly opening. We're still bullish on the year at 71.78, but I believe that it's possible that natural gas is causing this. And this is the power of the intermarket technical analysis, that even if this trade doesn't work, it points us to another trade. Now, I concede that there's supply issues with nat gas and everything else, but the fact that remains, the last 5 years in a row, Nat gas has gone up at this time, and it has an inverse correlation to oil. So further downside here is very likely on our oil contracts. But again, we need to hold below 80.86, the current quarterly opening. But now we can see that our T-cross long is intersecting with that quarterly opening, and that puts oil on the bearish spectrum for at least this current quarter. Now, when we look at the main Forex pairs, Euro US immediately reacting to the dollar moving higher, gold very strong in positive correlation between the euro and gold. Both backed off, and you can see that the euro fell at the same time. But I will point out, guys, the euro has never been positive on the year. There's been very good longs this last few weeks, and several times this year we've had good longs. But the primary trend is down. That's just the reality of this. 110.38 is the yearly opening price for this pair, and it simply was unable to break above it at any time during the calendar year. Now, the quarterly opening is important to us. We have good support at around 107.32. So if we can get down to this area, that would be potentially a buying opportunity. But again, that dollar usually is strong in its fiscal fourth quarter, which ends again October the 1st. I will keep repeating this, guys, so there's no confusion around this, that very often that dollar can, regardless of rate hikes, rate cuts, all these things, the dollar still tanks on October the 1st. There's very few years where that has not happened. So right now, a retracement is likely. Our immediate target is the T-cross long, 108.41. But between 108.41 and 108.72 or 107.32, excuse me, I believe that there's a reasonable long trade there still. We just need to let it push down a little bit lower as the market, as the bigger players start buying dollars in the month of September. Now, US Swiss franc slightly responding positive to this. As you can see, we may have a double bottom forming here at the low, 88.27. But regardless of dollar strength, most of your bigger players are moving into the Swiss franc, not the yen, not the dollar. So right now, there is an MA diff cross suggesting further dollar strength against the Swiss franc, but that would be a retracement to 89.42. Longs are reasonable. Just know your levels, guys. 89.72. 89.42, excuse me, and then the quarterly opening at 89.72. That's where our immediate resistance comes in for next week. We break above that, then we're likely going to see that dollar strength form going into mid-August and into mid-September area, which is possible, but that would still be a corrective move with the dollar ultimately moving lower in October. Now, the pound dollar had a very, very strong run this past week, as did the euro, but the pound was much stronger. So we've put a top in up here for now. That's 130.44. That's our immediate resistance. And then you can see we have stacked support with our quarterly opening down to 126.39, our yearly opening at 127.32. This is very, very powerful support down here. The T-cross long, as you can see, as we crossed the yearly opening and cleared, we actually never went below the current quarterly opening, not for very long anyway, the first day or two, and then we've extended higher. So I believe we have more downside momentum coming on this pair. And again, we would monitor that, but the first downside target, which is likely to be hit early next week, would be 129. Once, if we can, or excuse me, 128.54, the T-cross long. We can then reassess to the yearly opening price and the quarterly opening, but ultimately buying near 120, between 127.32 and 126.39 is a reasonable play. Now, the dollar yen finally succumbing to again, the yen rebounding somewhat here, but we're still at 157. The fear of intervention is still there. But right now, the VP indicators, right or wrong, good, bad, or indifferent, intervention, no intervention, it's saying that this pair is getting ready to go higher again. So once again, I would strongly advise to keep an eye on these critical levels. 106.72 is the quarterly opening on this pair. That and the T-cross long at 158.86. These are our retracement points, guys, but we're not buyers on this pair above 160 with pending dollar weakness coming in early late September, early October. Okay, so we've got to make sure we understand where these levels are, and that fear of intervention from the Bank of Japan is still lingering. I don't know if it'll have much effect, but as the Fed starts to cut, the carry trade will come unwound. If the Fed ends up cutting 3 times this year, that should knock the dollar yen back into the 130 area by year end. We'll see. That's a big move, but remember, it's made an extremely big move to the upside at levels I've never seen before, above 160. So again, I think we can buy up as long as we know where our upside targets are. Now, the Canadian dollar definitely under pressure here, and that is because of two things. The equity markets going lower, gold prices going lower, and oil prices going lower. All three of those correlate to the Canadian dollar. So right now, we've got some weakness. I think that it's reasonable that we can move up towards the high around 138, where we would be sellers in anticipation of pending dollar weakness a month and a half from now, maybe at 2 at the most. So I don't think we want to get too heavily long up here. The immediate resistance that we're going to look at is going to come in at the high of 137.55. Then we have multiple verified resistance highs coming in at, again, right around this 137.59 area, 137.92. So the immediate one we're looking at, 137.55, excuse me. And I believe we'll hit that early in the week. But always remember, I've discussed the Monday, Tuesday reversal in the VP Live training room and throughout these seminars or webinars, excuse me. A Monday, Tuesday reversal is very powerful on US Canada, regardless what the trend is. Meaning if it goes screaming higher on Monday, it's likely going to give up 50% of that on Tuesday. And if it goes screaming lower on Monday, it's likely going to go considerably higher on Tuesday. This is something I play almost every single week, and it has a very, very high win rate. So be careful of this pair. The lesson there is be careful of this pair. But the T-cross long intersecting with that quarterly opening at 136.72 is now becoming very formidable support here. So watch that level closely. Now, with the Aussie and the Kiwi, I am a firm believer that we buy on dips on this pair, but they will both come under pressure from lower equities. The S&P, the DAX, those going lower. When they turn, the Aussie and the Kiwi will turn back up. That's the intermarket correlation you want to keep your eyes on, guys, right now. So the Aussie dollar coming down and approaching that quarterly opening. But the real thing we want to look at, guys, and this is a great demonstration, is the current yearly opening price is 68.12 for the Aussie. The Aussie has never been above that level. And the second it got, well, no, actually that was 2023. So you can see the calendar year started, and this is the strongest retracement we've had. So on this pullback, again, the closer we get to mid-September, the more attractive longs on Aussie US and New Zealand US are, because again, even if we look at the US dollar as a reserve currency, it's been declining as a reserve currency, and they've been actually, the powers that be have been buying the Canadian dollar, the Aussie dollar, the Korean won, the Chinese currency. It's very interesting. So there is a lot of value in buying these pairs if you're a long-term trader. But if you want to wait a little bit longer, then I can say to a degree of certainty, about 80%, that the Aussie US and New Zealand US go up by late September into October, November, and December. It's a standard play based on dollar weakness. So right now, that is our key level, 66.76. If we break down below that and stay below that, then we are likely going to return into the lower 65 area, but that would be probably short-lived. I anticipate it to stabilize. The same with the Kiwi, guys, almost identical. You can see that we're failing along. The Kiwi is clearly the weaker of these two. Hence the Australia New Zealand, which I've shown on here in the past. When we look at the Aussie New Zealand, you may, again, I think there's better value buying New Zealand US than there is Aussie US, but that is often dictated by this extremely useful cross pair, Aussie New Zealand. So we have a lighter docket with data next week, but with that, there'll still come opportunity. So with that said, this is the Vantage Point AI Market Outlook for the week of July the 22nd, 2024.